Look, I've been conditioned for so long to expect the other shoe to fall that it is somewhat surprising to see how fast it has gone higher. But I think markets go higher to the upside than anyone really ever thinks possible. And if you take a step back and you are really being honest with yourself, ask yourself, why would the most powerful bank in the world in 2019 reclassify gold as the world's only other tier one reserve asset? And along those lines, why would the most well-funded and well-informed traders on the globe, the central banks, go on a repatriation and a buying spree since 2017 that the world has never seen before? Why would that continue unabated? And bring it closer to home, why would the United States become net importer since November of the world's only other tier one reserve asset? And we see the countries around the world that are voraciously accumulating gold. There's talks of it being pegged to a new system, as we were told by Dilma Rousseff, the former president of Brazil and the head of the New Development Bank, that they've agreed in principle to a new settlement currency called the unit, which is 40% gold backed and redeemable upon demand. And everywhere we look, from accumulation to repatriation to reclassification to slow moving higher, or even Judy Shelton, who you interviewed, who has told me flat out Trump is going, by her belief, will issue gold-backed treasuries next July, 2026, the 250th year anniversary. You put all of these puzzle pieces together in and of themselves, each one is significant, put them together, and it's almost impossible to not expect gold to go much higher. So yes, on one hand, as a guy who's been doing this since I was 19 for the last 35 years, I am surprised that it's moved in the manner that it has, as fast as it has. But when I take a step back and look at all of the pieces that are coming together quite eloquently, and outside the purview of the mainstream, mind you, which gives me more confidence that this is the right path, because, the insiders never want to be too transparent about the direction that things are moving. Yet they're positioning as if that is the direction that they're moving. To me, it becomes, well, yeah, that is pretty convincing that maybe indeed that is where we are heading. Quite frankly, if I were being completely honest, I would say that it's going to go higher than people think. You even Goldman Sachs or UBS, one of the two, coming out and saying, yeah, you could actually see $4,500 gold by the end of this year if things get bad in the bond market with the basis trade or whatever it is that could trigger that, raising their low end projections to north of 3,500. I think perhaps we're going to see gold outperform people's expectations, mine included. It's abating a bit, but we're still seeing big deliveries. I mean, not quite as big as we were seeing in February, but even still, we're seeing it in the March contract. We saw big deliveries, 50 million ounces of silver delivered in the first day of the March contract, 70 million ounces of silver drained from the LBMA in January. That's an all-time record. We saw massive amounts in February, still seeing it in March. It's happening, but part of the problem is that, Adam, is that the exchange in London is a T+1 exchange, and meaning T is the trade day plus 1 is a settlement. You're supposed to have it moving on its way over here in 3 days. They're now saying, well, sorry about that, Mr. Taggart. We know that you have a bunch of silver and gold that you have purchased that you need for your manufacturing and you're expecting delivery, but it's now T+8 weeks because we do not have enough trucks and manpower to move that, which is really nonsense. It amounts to a default. So part of the reason you're seeing it abate is because the LBMA has put the brakes on how fast they're sending it over here. But the trend of accumulation has not stopped. And one of the ways that you can see that is you see this massive increase right now in the premium in Shanghai, where silver is priced, I don't know, I think it's $7 or $8 higher than the London price right now. And gold is much higher, also trying to arbitrage all of that over. So you'll continue to see it happen, but it's as if the LBMA has gotten a little bit wise to it. Right now, silver in Shanghai is 7.2% higher in Shanghai than in London, and gold futures are only 0.5% higher than they are in London. But this higher premium, this arbitrage, again, is trying to entice what is left on the shelves to be moved over, whether it be to Shanghai or whether it be to COMEX. The trend is to take physical possession, and it's not stopping.
Let's be real about something up front. If you're paying attention to what's happening in the global gold market, you're not surprised. You might be impressed, even a little breathless, by how fast the price is moving, but surprised? Not really. Because when you've been watching the world's most powerful institutions reclassify, repatriate, and accumulate gold for the better part of the last 6 years, like I have, it's only a matter of time before the rest of the market catches up. But still, I'll admit it, I've been conditioned. Conditioned to wait for the other shoe to drop, conditioned to watch the price spike and then collapse, to expect spoofing, manipulation, and some algorithm out of London to crush every rally. That's been the game for years. But now something feels different. Because this move has teeth. And it's not being driven by Reddit threads or ETF flows. It's being driven by the smartest, best-funded traders on the planet, central banks. You want to talk about a signal? Let's go back to 2019. The BIS, often called the Central Bank of Central Banks, reclassifies gold as a Tier 1 reserve asset, on par with cash. Now stop and ask yourself, why? Why would the most powerful monetary authority in the world quietly make that move? Why, in the decade after 2008, when we were told gold was a barbarous relic, would they suddenly decide it was just as good as dollars and euros? And then, almost like clockwork, you see this tidal wave of central bank accumulation. Starting in 2017, we began to see sovereign nations hoard gold at levels not seen since the post-World War II era. In 2022 and 2023, we hit record central bank gold buying. This wasn't India buying a few extra tons for its reserves. This was China, Russia, Turkey, Poland, Singapore. Not a shopping trip, a strategic repositioning. And it wasn't just buying, it was repatriation. Germany wanted their gold back from New York. Austria pulled gold out of London. Hungary suddenly wanted 90% of their gold within their own borders. This is what nations do when they don't trust their counterparty anymore. This is what they do when the geopolitical weather turns stormy. Now fast forward to 2024. What's happening? The US, the country that holds the world's reserve currency, has become a net importer of gold since last November. And it's not retail investors driving this. This isn't coin shops in Kansas or retirement accounts in Florida. This is large-scale, institutional-grade accumulation. Someone is bringing gold into the US in size, quietly, without a press release. And the media, radio silence, not even curious. That to me is a green flag. And here's the kicker. Just weeks ago, a little reported statement came out from Dilma Rousseff. Yes, the former president of Brazil and current head of the new development bank. She says that BRICS nations have agreed in principle to a new settlement currency, the unit, 40% gold-backed, redeemable on demand. Now, whether that currency launches this year or in 3 years, that agreement in principle is huge. That's a massive step toward de-dollarization, toward a new global trade system where gold becomes part of the collateral again. And I'm not talking about a theoretical gold standard here. I'm talking about the monetization of gold at the sovereign level, within a multi-currency, multipolar trade regime. It's happening. And then you've got Judy Shelton. I've interviewed her. I've spoken to her at length. She's on record saying that she believes Donald Trump, should he win in 2024, will issue gold-backed U.S. Treasury bonds in July of 2026. That's the 250th anniversary of America's founding. You think that's a coincidence? That would be a bombshell. It would change the global bond market overnight. And it wouldn't just be symbolic, it would be strategic. It would be a way to draw capital back to U.S. debt without rate hikes or QE. Peg the bonds to gold, and you instantly re-legitimize your debt. Now think about all of this. BIS reclassification, central bank buying, repatriation, net U.S. imports, BRICS gold-backed trade currency, gold-backed treasuries. Think about the Shanghai premiums. Gold in China is trading well above London spot. Same for silver. That's called arbitrage opportunity. It's a flashing neon sign that someone wants the physical metal, not paper. And they're willing to pay more to get it, because the shelves are getting empty. And now the cracks are starting to show in the paper system. Take a look at the LBMA. They're a T+1 exchange. That means once the trade clears, the metal is supposed to be en route within a day or two, but not anymore. Now we're hearing about T+8 weeks. 8 weeks. Why? Well, they say, we don't have the trucks, the manpower. Give me a break. That's not a logistics issue. That's a supply issue. That's a system straining to meet obligations. That's a de facto delivery default dressed up as bureaucracy. You think that's a coincidence? You think it's random that 50 million ounces of silver were delivered on the first day of the March COMEX contract? or that 70 million ounces of silver were drained from the LBMA in January alone, a new all-time record, or that we're still seeing heavy deliveries in April, despite the delays. This isn't noise, this is signal. And it's not just silver. The same thing is happening in gold. The Shanghai premium today, over 7% for silver, 0.5% for gold. That tells you that arbitrage is in play. That tells you that someone on the other side of the world wants your metal, and they want it bad enough to pay a premium over spot. And guess what? The LBMA's wising up. They're deliberately slowing down the flow of metal out of London. They're trying to dam the river, but that only works for so long. You can't stop a trend that's backed by this much sovereign capital, this much geopolitical pressure, this much structural shift. That's where we are. That's why I'm not just mildly bullish. I'm convinced. And not just because the chart says so, not because some hedge fund went long a few contracts. I'm bullish because the people who run this system are positioning like they know something big is coming.
For the past 100+ years, the average price ratio has been 42 to 1. So, let me pull up my calculator here.
Okay.
If you just took the price ratio of, what do we got gold at today? Gold is
that like 32.30, something
yep.
like that?
So roughly 32.30 divided by 42, which is about the average price ratio of the last 150 years. That's $77. Keith Neumeyer, a buddy of mine, says that silver is coming out of the ground at 7 to 1. So take 32.30 and divide it by 7, and you get $461. Now, I'm not saying that's going to happen, but mathematically, geologically, if someone said silver would be $400 tomorrow, would it be that far off? Yeah, it sounds crazy. It does. That's short of the geologic ratio right now. So, there's man's ratio, there's God's ratio, you call it, which is the geologic ratio. The geologic ratio says it should be 460. The price ratio, because it's controlled on COMEX and on the LBMA, says differently. But I would argue that ultimately that's what this is about, with like the BRICS talking about building their own metals exchange. It's about control. It's about the fact that the West controls the price, and these other countries understand that. And I think that building an exchange allows the price setting to move from a system that is massively rehypothecated and in essence fake to one that is more indicative of its real value, real price setting. So I think silver will go higher than people think possible. But just speaking mathematically, if you said $400, it would not be outlandish. Now, I'm not saying that's going to happen tomorrow, but certainly to see it north of $45 an ounce is based upon 150, 200 years worth of price ratio between gold and silver. Western derived price ratio, that would just be reaching the average. So higher than people think possible. And once you get above 45, there is no resistance. So could it go much higher? Sure. I've never told people to buy gold and silver to become wealthy. It is wealth. It's outlived 2 world wars, German hyperinflation, the Great Depression, every pandemic. It's wealth. And the biggest money in the world is proving that, not only through accumulation, but maybe even more relevant is the repatriation. It's removing the counterparty risk that, right or wrong, the perception is it's not a good idea to leave it within the confines of the LBMA or the COMEX. And that's why you're seeing all of these countries choose to bring it home rather than allow it to be held by third parties. So these are all pieces of a bigger puzzle. I'm fond of the term logarithmic decay, which is little by little, then all at once. Well, It seems that the moves that are being made in accumulation and repatriation is the little by little, and it's continuing. With gold, the price is following along with it.
Let's not lose the plot, because this isn't a short-term trade. This isn't a technical breakout or a seasonal anomaly. What we're living through is a monetary transformation, a quiet revolution that, if you're watching closely, is happening faster than anyone expected. You want proof? Just look at the delivery data. The physical gold and silver being drained from the system isn't going to small retail investors. It's going to deep-pocketed strategic players, sovereigns, institutions, billionaires with connections inside the real infrastructure of metal movement, vaults, refiners, logistics networks. Back in January, we saw over 70 million ounces of silver drained from the LBMA. That's not just unusual, that's historic. The March COMEX contract opened with 50 million ounces delivered on day 1. That's not traders hedging. That's buyers demanding title. That's buyers who don't trust the system anymore. That's buyers saying, give me the bars. And remember, We're doing all of this in a market that's still officially functioning, still pricing silver under $30, still acting like there's no stress. But we know that's not true, because we're also hearing about delays, 8-week settlement lags, excuses about trucks and labor, as if the entire bullion logistics infrastructure suddenly forgot how to move metal. Nonsense. That's not a logistics issue. That's a capacity issue, a system stretched beyond its limits. And instead of admitting it, the exchanges are hiding it behind paperwork and protocol. T+1 becomes T+40. Deliveries get rerouted, reclassified, delayed. But the end result is the same. They're buying time because they're losing control. And when you lose control of the physical flow, when you can't meet your delivery obligations in a timely way, you lose the pricing power. You lose the illusion of abundance. And once that illusion breaks, it doesn't come back. Let me take you back in time, 1968. The US was still under the Bretton Woods system. Gold was officially $35 an ounce. But behind the scenes, the US was hemorrhaging gold reserves. Foreign central banks, especially the French, were redeeming their dollars for physical metal. De Gaulle knew the game. He saw the printing. He didn't want paper. He wanted bars. And the London gold pool? The system set up to maintain the $35 peg, it collapsed because the US couldn't keep the illusion going. The gold was leaving too fast. Confidence evaporated. And by 1971, Nixon had no choice. He closed the gold window. That was the end of the dollar's convertibility, the end of the gold standard. Now ask yourself, what's happening today? We're watching a modern version of the same movie. Paper claims outnumbering real metal. Pricing mechanisms detached from actual supply and demand. Physical leaving Western vaults at record speed. Sovereigns shifting reserves back into metal. And a growing chorus of leaders, especially in the BRICS countries, calling for a new system. That's not a coincidence. That's pattern recognition. And this time, the shift could be even bigger. Because we're not just dealing with gold. We're dealing with the collapse of fiat credibility itself. Let me explain. For the last 50 years, the dollar has reigned supreme. Not because it was backed by anything, but because it was used to price everything: oil, commodities, bonds, settlements. And that pricing power gave the US unmatched financial influence, sanctions, SWIFT control, access to capital markets. It was all built on the dollar's dominance, but that dominance is now being challenged. China is pricing oil in yuan. Saudi Arabia is in talks to accept non-dollar payments. India and Russia are settling trade in rupees and rubles. And the BRICS are openly discussing a commodity-backed trade currency, with gold as the anchor. Now, will this happen overnight? But it's already begun. The foundations are being laid. The clearing mechanisms are being tested, and the metal is being acquired. That's the key, because no matter what new system emerges, it will require trust. And that trust won't be backed by printed digits. It'll be backed by real deliverable assets: gold, silver, oil, food, lithium, rare earths, the things that don't default. And gold, once again, is at the center of that rotation. We're already seeing signs of that repricing. Not in the Western markets, mind you, but in Shanghai. Right now, as we speak, silver in Shanghai is priced over 7% higher than in London. That's the arbitrage spread. That's the real price of silver. And that spread is trying to tell you something. It's saying the physical is worth more than the paper. And that spread is likely to widen. Because once the market realizes that COMEX and LBMA are pricing metal based on a fantasy, the physical premium will break wide open. You'll see 10%, 15%, 20% premiums. Then you'll see no offer. That's how this ends. That's when the reset begins. And when it does, everything reprices. The price of gold, the price of silver, the value of miners, the cost of insurance, the perception of wealth. People ask me, Andy, what's the number? How high can gold go? And my answer is always the same. How much confidence are you willing to lose? Because that's what you're measuring. You're not measuring ounces. You're measuring trust. And once the trust goes, the price becomes undefined. Gold at $3,000? $5,000? $10,000? Sure, all on the table. And silver? Silver's a wild card. It's so underpriced, so neglected, so structurally tight that when it moves, it won't crawl, it'll leap. $50 is just the first stop. $100 isn't crazy, not in real terms. Not in a world where money supply has doubled every decade and deficits are spiraling out of control. You want a conservative framework? Look at the gold/silver ratio. Historically, it averages around 40 to 1. Today, it's hovering above 80 to 1. That means either gold is overpriced or silver is underpriced. And I'm telling you, gold is not overpriced. It's undervalued relative to every currency on the planet. So what's the plan? It's the same as it's always been. Get ahead of the curve. Start with physical metal, gold for stability, silver for leverage. Store it where you can access it. Don't trust third parties. Don't chase ETFs. Get the real thing. Then look at the mining sector. And I mean now, not when it's on the cover of Forbes, not when Jim Cramer starts talking about it. Now, while the juniors are still trading at 2016 levels. Now, while developers are still issuing stock to pay for drilling. Now, while no one's watching. Because when this breaks, and it will, these names will be up 300%, 500%, 1,000% before you can blink. Not because they became better companies overnight, but because the market finally realized what they hold, real metal in the ground. This is a once-in-a-generation setup. It's not hype. It's not theory. It's happening. You've got delivery failures. You've got international premiums. You've got paper market distortions. You've got sovereign shifts. You've got a system that's running out of options. The writing's on the wall. The train is leaving the station. And the question is simple. Are you on it? Because this isn't about getting rich. This is about not being poor in a world that's about to relearn what money really means. And in that world, gold and silver aren't commodities. They're lifeboats.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.